Hello and welcome. Today we will study Chapter 7, FX Option Transaction, the last chapter of Foreign Exchange Trading course. In previous chapters, we have studied several instruments, such as spots, forwards, swaps, and futures. They all share one common trait: irrevocability. That is, once the contract is signed, all parties have obligation to fulfill it. On one hand, it helps participants on FX market prevent price fluctuation risks. On the other hand, when prices change unexpectedly, it precludes investors from gaining extra profits or cutting losses. In this chapter, we will examine an instrument that provides investors with choices to deliberately execute the contract. It is FX options. After studying this chapter, you will be able to understand what is a FX options transaction and define it in your own words. Understand and explain relevant terms, such as call option, put option, strike price, expiration date, volume. Differentiate between American-style options and European-style options. Through some case study, you will be familiar with options applications and able to practice them. Ultimately, comprehending options trading, you could analyze its advantages and disadvantages. The first topic, overview of FX options trading, will introduce the definition and key terms. This topic will provide you with definition of FX options transaction, brief explanation of call option, put option, strike price, expiration date, volume. Short introduction to American and European style options, enough to help you tell the difference between these two. Distinguish between call option and put option, and when to use them. In his textbook of Foreign Exchange Trading, Associate Professor Dr. Wenmin Qiu defines FX options as a financial instrument, giving buyers the rights, but not the obligation, to buy or sell an amount of foreign currency at a predetermined price and date. Sellers are obliged to fulfill the contract if buyers exercise the rights. The central bank describes a foreign currency option transaction as an agreement between two parties, in which the buyer pays the seller to buy the right, but not the obligation, to make a spot contract, buying or selling a specific amount of foreign currency with another foreign currency within a period of time agreed upon by the two parties at the exchange rate determined at the transaction date. Breaking down the definition, we can see that FX options trading is a deal of trading the right to buy or to sell a specific amount of foreign currency at a predetermined rate and date. Hence, the buyer has the right to buy in case of call option or to sell in case of put option that amount of currency on the due date. However, the buyer has no obligation to exercise the right, meaning he has the choices of either execute the contract or not. On the other side, should the buyer choose to exercise his right, the seller has the duty to sell in case of call option or to buy in case of put option that amount of currency on the contract due date. To be conversant with options trading, let's look into related key terms. Who is the option buyer? Who is the option seller? What is the traded amount of currency called? What is the trading exchange rate called? What is the option price called? And how is it calculated? An options contract is an agreement between two parties, the buyer and the seller. The traded goods is, unlike other operations, not currencies, but a right, or we could say choice, option. So what is that right, or choice, or option? That is the right to buy or sell an amount of currency at a specific exchange rate. The buyer, called the holder, owns that right. In case he owns the right to buy, namely call, he has the right to buy an amount of currency at a specific exchange rate. In case he owns the right to sell, namely put, he has the right to sell an amount of currency at a specific exchange rate. Because holder also has the choice not to buy or sell, he is said to have the right, not the obligation, to execute the option contract. If should he find executing the contract beneficial, he would do it. Otherwise, he would not do it. He has the privilege to do whatever he find fit. That privilege, or say, advantage of the holder, costs him an amount of money. The price holder pays for an options contract is called premium, or option premium. The other party, who sells the right, is called the writer. Writers receive premium from holders. Because the writer sold the right, he has no right to refuse, or in other words, he has obligation to fulfill the contract when the holder exercises his right. Of course, if the holder chooses not to exercise his right, the writer won't have to carry out the contract. We can see that, in options contract, the seller, as known as the writer, is in passive position, which his readiness to honor the contract is required. Let's take an example to illustrate the positions of holders and writers. Corporation A is an import company. She buys a call option from Bank X to buy 150,000 euros at $1.1340 per euro. In this case, the option contract is agreed between Corporation A and Bank X. Corporation A is the holder. Bank X is the writer. The option is the right to buy euro. Corporation A pays Bank X the option premium $0.05 per euro for this right. The total amount of money Bank X receives as the option premium of this contract is $0.05. Multiply by 150,000 equal $7,500. After paying $7,500, Corporation A has the right, not the obligation, to buy 150,000 euros at $1.1340 per euro from Bank X. Let's see how she exercised this right. Suppose on the due date of the option contract, the spot price of euro is $1.1350. Then, should Company A execute the contract? If she executes the contract, she would buy euro at $1.1340 from the bank. Otherwise, she could buy euro at $1.1350 on the market. In this situation, executing the contract is more favorable since the company could buy euro at a cheaper price. Thus, she would execute the contract. The bank would suffer losses since it must sell euro at the price lower than the market price. Conversely, suppose the market price of euro on that day is $1.1320. Carrying out the contract means the company will buy euro at $1.1340 from the bank. If not, she could buy euro at $1.1320 on the market. That means, buying on the market is more beneficial than buying from the bank as the option contract. Hence, the company will not exercise the contract. That is to say, in FX options contracts, holders pay writers premiums for the rights to buy, or to sell, an amount of foreign currency at a specific exchange rate. Holders are in active positions to decide whether to execute the option contract or not. Whatever the situation is, holders bear no risk of exchange rate fluctuations. The solely cost is the premium. Writers receive premiums from holders. The premium is the highest profit the writer could gain from a FX option contracts. And the writer has the responsibility to fulfill the trade once the holder exercises his right. The next relevant terms we will examine are volume and strike price. The trading quantity or the contract value in options is called volume. This is the amount of currency traded and written in the contract. If an option transaction is conducted in the exchange, the volume would be standardized, similar to future trading that we have learnt in previous chapter. Otherwise, it is negotiable between the holder and the writer. In the last example, the volume is 150,000 euros. The trading rate, or contract price, is called strike price. This is the exchange rate that would be applied when the holder exercises contract and is written in the contract. The strike price in the example is $1.1340 US per euro. Next, we'll talk about European option and American option. The difference between these two styles is the time that holders could exercise the option rights. In European option contracts, holders could only exercise the rights on the contract due date, or called the expiration date. For example, on the 13th of March, 2019, company A buys an euro call option from Bank X. The expiration date is the 13th of June, 2019. In European style, the company could only execute the contract on practically the 13th of June, 2019, not even a day before or after. Conversely, the American options allow holders to practice the rights at any time before and including the day of expiration. Take the above example. In American style, the company could exercise the contract virtually any day by the 13th of June, 2019. And the writer is obliged to make the transactions. So, which one would you prefer? American style option or European style option? Evidently, American style options are more flexible and give holders extra advantages. For that reason, American style option premiums are always higher. Obviously, since the more advantages for holders, the more risks for writers. Also because of American style option flexibility, its premium calculations are more complex. The next term we discuss is expiration date. Expiration date of an option contract is the effect duration of the contract. Beyond this date, the contract will expire. That means the holder could not do anything about the contract after this date. In American style option, it's a period of time, from the contract signed date to the contract due date. Whereas, in European style, it's a specific date written in the contract. In video part 2 of this topic, we will got into details of essential terms such as option premium, call option, put option. Thanks for watching and see you then.